This is a company's cash flow statement, and your ability to interpret the information in this very important financial statement could be the difference between making great investments time after time and making investments that you really regret. In this video, I'm gonna share with you what the different patterns are in terms of a company's cash flow statement and what those patterns tell you about a specific company and how you can use that information so that you can make some great informed investment decisions. The first step to analyze the cash flow statement of a company is to get the statement in the first place. For that, we are going to get it for Apple, a very familiar company, and we're going to get it on an annual basis. After you do this, you can just click on Get Data, and by the way, this is all powered through the Y-Sheets add-on that you can get on Excel and Google Sheets. But regardless, you can also get the data in other ways as well. Here, what we're focusing on is, of course, the cash flow statement. Now, when it comes to the cash flow statement, there's three different sections that are very important for you to know. So first, we have the section that talks about the cash flow generated by operating activities. Then we have the cash flow generated by investing activities, and then the cash flow by financing activities. For all of these different sections, what you will see is that you basically take the sum of all of the different items, and this results in the same number that you can see right here. The same calculation applies to all these different sections, but each section represents a different kind of cash that is generated by the company. So this section right here represents the cash that the company was able to generate just from its regular operating activities. That means the regular sale of its goods and services that the company provides. Now, for the investing activities, this cash flow is a little bit different, and the reason why is because this is the cash flow that was generated by the company via investing activities. And for all of these cash flows, the thing that you need to know is that they could be positive or negative. If it's positive, it means that the company gets to keep that cash flow and use it for whatever the company wants. If it's negative, it means that it resulted in a loss of cash for that particular company. The last type of cash flow is the one provided by financing activities, and this is cash flow that the company was able to generate or lose based on raising money or paying money back to investors and debt holders. Now let's talk about the actual cash flow patterns. What I mean by the cash flow patterns is that, as we said before, these different numbers right here, they could either be negative or positive. And whether they're negative or positive, that tells you something very important about the company that you're analyzing. So a company that is well established generally has a very positive and very high operating activity cash flow. This means that the company is able to run its operations smoothly and generate a good amount of cash just from those operations alone. If the company has a long history of negative cash flow in this area right here, usually means they're not an established company. Maybe they're losing money potentially, and typically you see this in startups and companies that are investing a lot of money into growth that is resulting in actual losses of cash flow in this particular area. Now, moving on to the pattern for the investing activities, generally what you want to see is a negative number right here. What that means is that the company is actually taking money and investing it, assuming they're able to invest it in things that actually make sense for the company to grow. That is generally a good idea, especially if they're making good returns on the money that the company is investing into the different initiatives. So it is good to see this number be negative, like it is the case for Apple in many instances. If you see that the company has a positive number over and over and over, generally it's not the best thing, because usually means that the company, instead of investing in new things, is kind of selling those things to be able to gather cash. So generally not the best indicator, but just something for you to keep in mind. Now, for the last section, the financing activities, this really depends on the company and what is happening on their operation. So for example, if the cash flow here is negative, like it happens for many different companies, this means that the company is usually using the cash to satisfy the existing investors, and this could be done in the form of dividends or share buybacks or stuff like that, or paying off debt that the company accumulated in the past. What you see typically from very stable companies is they have this pattern right here, and this is because they've used that in the past. They have a lot of cash, so they're like, you know what, let's just pay that debt off. So you see those negative cash flows. Now, if the company is young and it's a startup and it's losing money, a lot of the times what you see is a positive number right here. And what this means is that the company is raising money, and this could be in the form of debt, or a lot of the times it's also new stock that is issued to be able to raise funds so that the company can use that money to continue to invest in its operations and new growth initiatives. Altogether, here's a really powerful graphic that summarizes all the information that we went over this video. So for example, let's say that a company has a positive cash flow from operating activities, a positive cash flow from investing activities, and negative cash flow from financing activities. This means that the company is using cash from operations and from the sale of fixed assets to pay down debt or pay the owners. And this is kind of what we found with Apple. But as you can see, depending on the different patterns, this tells you something really unique about the specific company that you're analyzing. And this is information that should really be taken into account when you're making investment decisions. There you have it. Now you understand the different patterns of the cash flow statement and what that tells you about specific companies that you're analyzing. So be sure to use this information so that you can make some great investment decisions for yourself and for those people that you most care about. If you've enjoyed this video, make sure to subscribe and like the video, and I'll see you in the next one.